Let's take a look here at the number with Scott Bauer. Let's bring him in. He's the CEO of Prosper Trading Academy. He's joining us this morning to talk producer price index. Scott, welcome. Thanks for doing so. Good morning. Let's talk about how, well, if you were looking for a reason to come in and do some buying here today, maybe not from this PPI number. Again, it's sort of pointing to higher than expected inflation, which is going to feed right into that hawkish tone that everybody's expecting to hear from the Fed. We're looking at it now, core PPI on a month over month at 0.7. They were looking for 0.4. Year over year at 7.7, Scott. Look at the PPI year over year for 9.6 and PPI month over month at 0.8. Across the board, all of these numbers higher than expected.
It is a very hot number.
Yeah.
PPI has been a fairly reliable forward indicator for CPI, for consumer inflation. So, I'm not sure how much this is actually going to work into what the Fed talks about today and tomorrow and what their decision is. But certainly it didn't do anything to damper any expectations of not tapering sooner, and also of forward interest rates, what those may be. And the likelihood is that we're going to see end of quantitative easing probably by March, and perhaps a first hike. Certainly, I don't want to say certainly, but the chances are by June pretty good, and maybe even before that.
Yeah, we were mentioning that at the top of the show. Scott, I'm watching treasuries. They're still fairly range bound, holding near the highs from yesterday. So that's the futures, which means rates are holding near the lows to begin the week. But what are you seeing in terms of the U.S. dollar as of recent? It's been, as scientists and traders are in a bit of a wait-and-see mode with this Omicron variant, so does the dollar seem to be.
No doubt about it. And it's coming off just about its weekly highs or so. But as you said, it is certainly range-bound. It is waiting. I mean, it's percolating, it's coiling and waiting for that next move to see maybe what the Fed does. And I think without the Omicron variant, it's certain what the dollar would have done based on the Fed. But I think that is just the wild card, as we've kind of seen over the last, 12 to 18 months or so.
Quick look at, there's the 5-minute time frame, that chop, as you mentioned, the weighting, the sideways consolidation. Let's take a step back and look at this daily. It had been running up, and then it just went sideways again after topping out around 97. And just a quick look here, because remember this low for a second, that 89 lower level. When we step back from this daily and look at the weekly, you can see, well, that's where we bottomed out recently, around 89. It coincided with the lows that we saw back in the beginning of 2018. And you can see we're basically into the middle of this range that's been established over the last 6-7 years. Scott, talk to us about some of the other currencies you have your eye on this week. We've got a lot of central bank activity going on. It's not just the Fed, Bank of Japan, the ECB, the Bank of England. We were talking earlier in the show about how all of those currencies, for the most part, have been weakening.
They have been, and throw in Swiss National Bank also, and the euro probably has been the weakest and maybe the most vulnerable based on what the dollar does, and if there's faster tightening here than what the ECB comes out with, that may be the most vulnerable. But it's a lot of activity this week, Ben, and we're likely to see lots of volatility across the space and currencies. In especially the Bank of Japan and the ECB is that's really where I see maybe the most volatility coming in. But yeah, the dollar is going to be driving what these other currencies do, as it is expected that the Fed here may be the most hawkish of all of the other central banks that are out there.
And we're seeing a reflection of that in terms of price activity. Here's the euro currency. It's been coming off just real quick. Here's a look at the yen. It's been coming off. So these are definitely products to watch this week. Scott, a minute ago we were talking about the indices, and indices in Asia and how they've been feeling some of the weight of investors' concerns and unease ahead of some of the expectations from the Fed, in addition to Omicron variant concerns. And ultimately, I know you watch some of the Asia market-specific currencies very closely as well. The 6N, I just noted and pointed out how it's been coming off under pressure, and a reflection of some of those concerns, I guess. It's not just the indices over there that are showing some kind of cracks in the dam or weakness there, at least in terms of some of that optimism, that sentiment.
No, not at all. As you said, the 6N, the New Zealand dollar, also the Aussie dollar. Absolutely. It has been risk off there, a lot of concern, a lot of volatility. A lot of nervousness, quite frankly. And the number that we got today here, this PPI number, is not going to do anything to dampen that whatsoever.
Quick look here at the Aussie dollar as it has been on the decline. Now it recently regained composure. It's about, well, it looks like about 200 ticks, 130 ticks, it looks like, I guess, off that low that we saw in the beginning of the month here. Again, on the 3rd, it looks like it was, and we've rallied off. Scott, real quick, in terms of as we head into the end of the year, what are you looking for as far as rates? We were talking about the dollar. It's been somewhat sideways. Rates in a bit of a holding pattern as well. Are we going to get something from the Fed, something definitive, specific enough to tip the scales one way or the other, I'd imagine, to the upside for rates? But what are you seeing in terms of that possibility or lack thereof? I mean, they seem, again, as we head into the year, kind of comfortable at these levels, to say the least.
I'd say the market has been confusing, Ben. I think we're all confused why rates aren't higher, why there's still a bid on the 10-year, on the 30-year. It's pretty much a foregone conclusion, at least in my mind, what the Fed is going to announce. And I think that they finally need to, pull the plug. I think they really do, and just say, listen, this is hotter. We know that transitory word is gone. And we are accelerating the taper. We are expecting to raise rates. Is that going to bring a market shock? Maybe. I'm not so sure. I think the market is actually pricing that in. And any sort of waffling by Powell and the Fed and any sort of maybe putting this off further, I think is actually a negative for the market. I think the market just wants to see the news already and can accept it pretty good.
Yeah, the transparency, it seems like they've been fairly comfortable with. And while it's not necessarily what the market wants, higher rates, we're still at historically low levels, so I think it's willing to accept that. And I agree with you. Let's lastly talk about Bitcoin. I know you keep a close eye on cryptos as well. Some of the weakness there. We mentioned the indices taking out some key psychological levels. I'd imagine that's one of those psychological levels in terms of Bitcoin being that 50,000 level, and it is below it.
Absolutely. And the next level really is about 43 to watch on the downside. The last couple days, or maybe 4 or 5 days, as we've seen Bitcoin sell off around 46, 45.5, it's bounced kind of like it did this morning. Not a big bounce, but it bounced a little bit here. And I think that cryptos right now are in a little bit of the wait and see, just like the dollar is, based on the Fed. However, there is not really a good correlation between crypto and the Fed, because honestly, the last time that the Fed, was hawkish and went into a tightening sort of scenario, Bitcoin was trading $450. That was 5-6 years ago. So I don't think that there's a heavy correlation, but I do think, just like other assets out there, Bitcoin is very much in a wait and see over the next day and a half.
It's been tough to find a correlation to anything in many ways with Bitcoin here. Scott, as we head into the last couple weeks of the year and while holiday markets start to become more and more prevalent, some advice to our viewers in terms of how to handle that. We were talking earlier in the show with Jerry Parker about how you just kind of scale back some of your size. He basically said, hey, enjoy the holidays. You don't have to trade 24/7, 365 days a year ultimately. I mean, it's okay to take some time off.
Yeah, this will be year number 32 going through the holidays for me as a professional trader, and I couldn't agree with that sentiment and that advice any further. There's no reason to pound the table on position taking here. Keep it light. Keep positions maybe on the lighter side, tighter. Markets kind of thin out a little bit over the next couple of weeks. Becomes a little bit more difficult. Historically, we do see a rally the last 10 days or so of the month. I'm not so sure we're going to get that. So I think that everybody has to be cautious, take a step back, and yes, enjoy the holidays.
All right. Words of wisdom. Scott, always appreciate you joining us. Scott Bauer, the CEO of Prosper Trading Academy, helping us take a look at the inflation data and market reaction too. We're going to take a quick break. Stay right where you are. When we come back, we're going to